Hi, I'm Jimmy. In this video, we're going to look at 5 of the most interesting dividend stocks going into 2022. So these are 5 dividend stocks that, one, pay decent dividends, but also they look like they could have some upside potential thanks to either they're looking undervalued right now or perhaps today's macroeconomic environment. Okay, now if you're curious where these dividend stock ideas came from, well, we actually do on our private investing community. We have these weekly live streams every Friday that we do. We go through and try to value a whole bunch of companies that the community throws at us. All of these dividend stocks came from that valuation. Now, we're also getting ready to launch our upcoming website. We're expecting for it to be up in about the next 6 months or so. And basically, this is a quick way to value stocks where you could run through a whole bunch of different companies and use our own weighted average cost of capital and try to see if we can find good companies that need more research, a lot like these 5 dividend stocks. So quite impressively, our community has found a whole ton of really good ideas. That's been the most amazing part about the community. But either way, just want to share that with you. I will leave a link to how to sign up to that website and get access to the community. If you're curious, I'll leave that in the description below. But for now, let's jump into our 5 dividend stocks. First up, we've got a company that lands in the materials sector called LyondellBasell, ticker symbol LYB. LyondellBasell has a dividend yield of almost 5%, and when we use analyst estimates for free cash flow going out the next few years, well, it looks like this stock could be undervalued. By the way, this is the functionality of the website that we're building. This is an Excel spreadsheet that we build that we use on the live streams, but this is the basic functionality that we expect to have within the website. And basically, in our example here, well, we're using a required rate of return of 7.5%. And using that, this stock looks like it is undervalued at this point. But also, if we wanted to use the company's, their own weighted average cost of capital, which many textbooks say is a good required rate of return to use, well, using their own required rate of return, well, it looks like the stock could have some decent upside as well. Plus, on top of that, they're paying a 5% dividend. So again, this looks like a really nice combo. And perhaps this could be a good diversifier for our portfolios. Okay. Next up, we've got a dividend stock that I think could do nicely, really, when we consider today's macroeconomic environment, higher inflation, possible going up interest rates, and that is Citigroup, ticker symbol C. Right now, the dividend yield for Citigroup is about 3.4%. But we may also notice that discounted free cash flow is not working for Citi. And that's because banks and many other financial stocks, discounted free cash flow isn't really well suited for that valuation method. A much better valuation method to use is to use something like price to book value or price to tangible book value. So this is a chart, another one that we use that we're trying to put into the website. This is a chart of Citigroup's price to tangible book value going back the past few years. And the average over this time period, well, that's the red line. Ideally, what we want to do is pay, if we're going to buy the stock, we want to buy it when it's below the average, implying that the stock is undervalued. So once again, it looks like Citigroup is at that point today, and we combine that with the dividend yield that they pay, and this looks like this could be a good stock to own going into 2022. Okay, now let's jump over to some real estate holdings. This is Vici Properties, ticker symbol VICI. And we can see that this is a real estate company that pays about 4.5% dividend, which is pretty good. Now, discounted free cash flow doesn't really work for this type of company. A better valuation method instead of discounted cash flow, if we're looking at REITs or real estate investment trusts, a lot of real estate companies in general, a better valuation method to use is something like price to funds from operations. More accurately, if we can find it, again, we're going to put it on the website, but more accurately would be something like price to adjusted funds from operations. This is a lot like earnings per share that you would typically see with most companies, except this applies to REITs or real estate investment trusts. Either way, we can see that Vici Properties looks like it's undervalued. Combine that with their dividend yield, and again, it looks like this could be a good, if we need some exposure to real estate in our portfolios, this could be a good addition. Now, I should also point out that the expectation here is that we're going to do deeper dives and full videos on each of these stocks going forward, but I wanted to share that these look like these are companies that could be worth buying quickly if we've done the deeper dive. I haven't done that yet, but I plan on doing that for each of them. I have looked at them briefly, I've looked at the numbers, and overall, I like what I'm seeing so far. Okay, let's continue on. Next up, we've got H&R Block, ticker symbol HRB. So H&R Block pays a dividend yield of about 4.5%, and discounted free cash flow can typically work for this type of company. Although I do think it's important to point out that here, our analyst estimates for 3 out of the 4 years, only one analyst is contributing to those estimates. So it doesn't look like the company is it's not covered terribly wide by Wall Street. So we might want to hedge how much we lean on this type of valuation. The good news is that if the number is anywhere near what this analyst is predicting, well, this stock looks like it could be way, way undervalued. And even if we wanted to use a required rate of return, in this case of 12.5%, well, the stock could still be undervalued. So I think this is one of the reasons why this one is absolutely worth a deeper dive, because it has big potential upside. And in the meantime, we get to collect a fairly good dividend. Okay, another stock that's in a similar position, but just has a few more analysts covering it, and that is HP, ticker symbol HPQ. And we can see that HP has a dividend yield of about 2%, a bit over 2% right now, which is decent. It's one of the lower ones on our list, but again, big potential upside here. Using a 7.5% required rate of return, well, the stock could be worth $83 per share. Even if we used a required rate of return of 12.5%, well, again, the stock would still have some upside. And if we used the more textbook weighted average cost of capital, again, the stock looks like it could have some impressive potential upside. So again, this looks like a dividend stock that could potentially be a great addition to our overall portfolio. Now, if you want to get access to this website, once it goes live, of course, well, I will leave a link in the description below and right here for how to sign up to this website. Now, the good news is for anybody who signs up today, we are locking in the price, that price will never go up on you, even once the website's up, and we do increase the prices for access to the website. So if you want to get access, link right here, link in the description below. Thank you so much, and I'll see you in the next video.